Hi, I'm Grant Mundell, Investment Specialist at Equity Trustees with the December monthly market review. In December, share markets mostly fell. In local currency terms, the ASX 200, US S&P 500 and MSCI World ex Australia Index fell 3.2%, 2.3% and 2.7% respectively. The key reason for the pullback was due to the more hawkish commentary from the US Federal Reserve, who signalled a slower than expected interest rate easing path in 2025. Markets have rallied strongly over 2024 due to strong corporate earnings, particularly from large technology companies, resilient US economic growth, slowing inflation, and the commencement of interest rate cuts from central banks around the world. Equity markets have also cheered the Trump victory, as his policies are generally seen as being equity market friendly, given promises of lower taxes, deregulation, and supportive fiscal spend. However, those policies are also seen as inflationary. High inflation means less chance of rate cuts. Therefore, bond yields soared, as did the US dollar. In fact, US dollar strength has been particularly notable. The Aussie dollar fell 5% in December alone against the greenback and more than 10% during the December quarter. The large fall in the Aussie dollar meant that unhedged global equities actually rose 2.6% in December. Within the ASX, defensive sectors fared best in December, whilst property trusts and materials lagged. Global economic data painted a similar picture to that throughout the year. That is, robust US data, subdued European prints, and divergent Chinese data where exports and manufacturing have tried to offset the slowdown in domestic demand and sluggish real estate investment. There are some signs of stabilisation in China on the back of increased stimulus, but investors remain somewhat sceptical and future policy is likely to hinge on Mr. Trump's tariff announcements. Within Australia, the labour market remains tight. The unemployment rate surprised by falling back to 3.9%. However, GDP data showed that outside of the public sector, growth is subdued. We expect the RBA to cut 2 times next year, starting in May. Overall, investment returns for growth assets in 2024 were very strong, led by strength in the US economy and ongoing market leadership of the Magnificent Seven technology stocks. Equity markets rallied as the odds of a soft landing scenario increased, with ongoing resilience in US consumer demand, solid productivity gains, and moderating inflation being supported by interest rate cuts by the US Federal Reserve. As mentioned earlier, higher bond yields led to equity markets retracing in the final weeks of December and will remain a cap to US equities in the face of unchanged or lower growth expectations. US equity market earnings growth should remain supported in the near term by ongoing strength in megatech earnings and a broadening of growth in the market as interest rate cuts feed through the economy. Earnings growth for the ASX 200 in calendar year 25 is forecast to rise 4% as interest rate cuts support economic growth. However, earnings have consistently been downgraded over the last 12 months. The Australian market will remain heavily influenced by the banking sector, which is re-rated to elevated valuation levels, industrial companies, which will need to offset cost increases in the face of a weak consumer, and soft commodity prices impacting on resource company earnings should substantial extra Chinese stimulus not be deployed. Our current view is to employ a modest underweight tactical tilt in equities, as we believe the market is already pricing in an optimistic view of the path ahead. Elevated valuations leave little scope for adverse surprise or disappointment. The relative valuation appeal to bonds is also not as attractive as it has been in recent years. We offset this underweight in equities with a mild overweight in defensive assets. We believe the outlook in fixed income returns looks reasonable as yields are at more sustainable levels and provide a degree of income support and diversification for clients wishing to moderate portfolio volatility. The running yield on Australian listed credit is also currently attractive. The asset class is supported by reasonable economic conditions and relatively conservative corporate gearing. Lastly, cash offers steady near-term returns along with strong defensive characteristics. We continue to note that while macro factors are important, in more challenging economic conditions, it is beneficial to focus on basic micro factors as to what makes a good business an investment. Our investment processes focus on strong bottom-up fundamental attributes and appropriate valuations. We believe that active management in the right areas can contribute to strong overall returns, and at this point of the cycle, we believe diversification within and between asset classes is very important. I'll be back again next month with the January monthly review.